The number was $6 trillion. That's what I kept coming back to. Not the policy memos. Not the academic white papers. The number. $6 trillion, roughly the entire economic output of Japan, quietly bled out of American household balance sheets between 2007 and 2012. Gone. And what replaced it wasn't recovery. It was a monthly payment. That's not a recession. That's a transformation. I found this while researching something else entirely. I was looking into the history of savings rates in post-war America, the kind of deep archival work that sends you sideways through Federal Reserve reports and Congressional Budget Office tables from the 1970s. And somewhere in the middle of a data set from the St. Louis Fed, I hit a cliff edge. A number that made no historical sense. And then I started pulling the thread. What I found wasn't a simple story about bad mortgages and reckless banks. It was something older. Something with a pattern. And once you see the pattern, you cannot unsee it. Let me start with the numbers, because the numbers are where everything begins. In 1980, the American personal savings rate sat at roughly 17%. That means for every dollar earned, an average household set aside 17 cents. This wasn't unusual. It was, in fact, exactly what post-war economic planners had designed the system to produce. The New Deal era, the GI Bill, the expansion of Social Security, the creation of employer pensions, all of these were mechanisms for converting American labor into American wealth. The savings didn't just sit in bank accounts. They capitalized local banks. They funded municipal bonds. They built schools and sewage systems and the interstate highway system. Savings, in the post-war model, was the engine of sovereign national investment. By 2005, that number had dropped to below 1%. Let that settle for a moment. The most prosperous nation in human history, at the peak of a declared economic boom, had nearly eliminated personal savings entirely. Not through catastrophe. Not through war. Through policy. The official story goes like this. Americans grew wealthier through asset appreciation rather than cash savings. Home values climbed. Stock portfolios expanded. The 401k replaced the pension, but that was progress, individual freedom over institutional dependency. Consumer spending powered GDP growth. Debt, manageable at low interest rates, was simply rational economic behavior. The system was working. The warnings from economists like Wayne Godley and Hyman Minsky about debt-fueled growth instability were, the official narrative says, too theoretical for practical consideration. Let me be fair to the official narrative. There were genuine productivity gains in the 1990s. Technology did create real wealth. Globalization did lower consumer prices. And low interest rates did make monthly debt payments manageable for millions of families. The boom, to many people living through it, felt real. Because parts of it were. But here's what matters: who captured the gains, and who assumed the risk. Let's start at the beginning, or rather, a very specific beginning. October 15, 1966. That is the date the Federal Reserve, under Chairman William McChesney Martin, raised the discount rate for the fourth time in 2 years, directly choking off credit to the housing sector. It was, at the time, understood as prudent anti-inflation policy. Standard macroeconomic management. But it triggered something the official histories rarely connect to it: the beginning of a systematic withdrawal of long-term savings mechanisms from the American middle class. Speaking of savings mechanisms, there's a document worth mentioning. It sits in the National Archives in College Park, Maryland. A 1971 Treasury Department internal memo, partially declassified in 1992, marked simply, Domestic Finance, Balance of Payments. The memo, prepared for Undersecretary Paul Volcker, yes, that Paul Volcker, outlines the problem clearly. The United States had closed the gold window in August of that year, and the question now was what would anchor dollar demand globally. The answer the memo arrives at is not something most monetary historians highlight. It's not gold. It's not productivity. It's debt issuance. Treasury securities, consistently purchased by central banks and sovereign funds, would be the mechanism by which the dollar maintained global primacy. The memo uses the phrase, structured demand creation. Structured demand creation. I don't have answers, only patterns. But that phrase appears again, in different language, in documents from the Reagan Treasury in 1982, the Clinton-era Financial Deregulation Task Force in 1995, and, in a nearly identical formulation, in a Federal Reserve working paper from 2003 on Consumer Balance Sheet Dynamics. Which brings me to 1978. The Revenue Act of 1978, specifically Section 401k, is usually told as an accident, a tax loophole discovered by a benefits consultant named Ted Benna, who realized employers could use it to replace defined benefit pensions with individual investment accounts. The official history frames this as organic innovation, bottom-up capitalism at its finest. But the Treasury Department had been quietly encouraging the displacement of defined benefit pensions since the early 1970s. A series of regulatory changes, the Employee Retirement Income Security Act of 1974, the shift in actuarial assumptions for pension funding, the gradual erosion of the Pension Benefit Guaranty Corporation's effective authority, had made traditional pensions increasingly costly for corporations to maintain. The 401k didn't emerge from nowhere. It arrived into a legal and regulatory environment that had been specifically shaped to receive it. By 1990, more than 48 million American workers had seen their defined benefit pension replaced by a defined contribution account. By 2000, that number was 73 million. The distinction matters enormously. A defined benefit pension is a guaranteed income stream, wealth that cannot be lost in a market downturn. A 401k is an investment account that absorbs all market risk. The worker who had a pension in 1975 was protected from the 1987 crash, the dot-com collapse, and the 2008 financial crisis. The worker with a 401k was not. The timing is almost theatrical. Between 1982 and 2000, the Dow Jones Industrial Average rose from roughly 800 to over 11,000. An extraordinary run. And American households, increasingly dependent on stock market-linked retirement accounts, felt wealthier than they ever had. Paper wealth. Asset wealth. Wealth that existed as long as prices kept climbing. Speaking of prices climbing, let's talk about what was happening to wages during the same period. Between 1979 and 2019, productivity in the United States increased by roughly 59%. In the post-war era, wages tracked productivity closely. When workers produced more, they earned more. After 1979, that relationship broke. Real wages for non-supervisory workers grew by less than 16% over the same 40-year period. The gains from productivity growth went somewhere. They went to corporate profits, to shareholder returns, and to executive compensation. But not to wages. That's not a market correction. That's a redistribution. What no one explains is how you maintain consumer spending, which accounts for roughly 70% of GDP, when wages are stagnant. The answer, it turns out, is that you don't need wages if you have credit. The deregulation of consumer credit in the 1980s is usually framed as a freedom story. The Supreme Court's 1978 Marquette National Bank decision allowed lenders to charge the interest rates of their home state regardless of where the borrower lived, which is why every major credit card company relocated to South Dakota and Delaware, states with no usury caps. The Depository Institutions Deregulation and Monetary Control Act of 1980 phased out interest rate ceilings on deposits and loans. The Garnesti-Germain Act of 1982 unleashed the savings and loan industry. Each step, taken individually, appears reasonable. Taken together, they form a coherent architecture, the systematic removal of every legal restriction on the expansion of consumer debt. By 1990, total household debt in America stood at roughly $3.6 trillion. By 2008, it had reached $13.8 trillion. That is a 280% increase in 18 years. Inflation-adjusted GDP grew by roughly 60% over the same period. Consumer debt grew nearly 5 times faster than the economy. The pattern indicates something deliberate. But let me be precise about what I mean. I am not suggesting a room of people with a whiteboard planning the dispossession of American workers. What the documents suggest, and the documents are extensive, if scattered, is something more like institutional momentum. A set of incentives, legal changes, and ideological commitments that produced predictable results, consistently, over decades, regardless of which party held the White House. Maybe that's reassuring. Maybe it's not. Let me give you a specific archival moment. November 12, 1999. The Gramm-Leach-Bliley Act is signed into law by President Clinton. This is the legislation that formally repealed the Glass-Steagall Act of 1933, the Depression-era law that had separated commercial banking from investment banking for 66 years. The reasoning offered at the time was that American banks needed to compete with larger European universal banks. The risks of combining deposit-taking with securities speculation, which Glass-Steagall had been explicitly designed to prevent, were, according to the consensus view, manageable with modern risk assessment tools. There's a letter in the Federal Reserve's public records, dated March 1997, from then Fed Chairman Alan Greenspan to Senator Phil Gramm, who had co-sponsored the repeal legislation 2 years later. The letter outlines Greenspan's view that Glass-Steagall was an anachronism, and that the financial system has evolved to the point where its continued applicability is questionable. What the letter does not mention, what no public document from that era seriously engages with, is that the models being used to assess risk in complex financial instruments had never been tested in a genuine crisis environment. The value-at-risk models, the Gaussian copula functions that would eventually be used to price mortgage-backed securities, were theoretical constructs. Their failure mode was not unknown to mathematicians. It was simply not discussed in policy circles. The model assumed housing prices never fell simultaneously across all markets. The historical data didn't support this assumption. But the data only went back to 1975. Which brings me to the part that keeps me up at night. Between 2001 and 2006, roughly $2.5 trillion in subprime mortgage loans were originated in the United States. These were not simply loans to unqualified borrowers, though many were. They were loans that were immediately packaged into securities, rated AAA by agencies paid by the issuers to rate them, sold to pension funds and sovereign wealth funds and municipal investment accounts around the world, and removed from the balance sheets of the originating banks within weeks of closing. The bank that made the loan had no exposure to whether the loan was repaid. The incentive to verify income, employment, or ability to pay had been structurally eliminated. There are origination records, held by the Federal Housing Finance Agency, the Office of the Comptroller of the Currency, and various state banking regulators, that document the scale of this process in granular detail. Some of these records are publicly accessible. Some are not. A 2010 report by the Financial Crisis Inquiry Commission noted that significant gaps remain in the documentation of loan-level origination practices between 2004 and 2007, particularly for loans originated by non-bank mortgage companies, entities that, unlike FDIC-insured banks, faced minimal regulatory examination. The gaps are notable. The Commission requested documents from 14 major financial institutions. Several reported that certain categories of internal communication from 2005 through 2007 had been, in the language of their legal responses, subject to routine data management protocols, which is to say, deleted. Whether this was standard corporate document retention or something else is a question the Commission was unable to resolve. The relevant documents were gone. Let me assemble what we do know. The savings rate, at 17% in 1980, was functionally eliminated by policy over 25 years. The pension system, which protected 73 million workers from market risk, was replaced with individual accounts that transferred that risk entirely to workers. Wages were decoupled from productivity gains, producing a structural shortfall in consumer purchasing power. That shortfall was filled with credit whose terms became progressively more exploitative as regulatory constraints were removed. The resulting debt pyramid was then securitized, distributed globally, and rated as safe. When it collapsed, the losses were socialized through the federal government and the Federal Reserve, while the institutions that had created the instruments were, in virtually every case, made whole. Between 2008 and 2015, American banks received approximately $700 billion in direct TARP funds and had access to Federal Reserve emergency lending facilities totaling, according to a 2011 Government Accountability Office audit, over $16 trillion in cumulative loans at near zero interest rates. Meanwhile, an estimated 8.7 million Americans lost their jobs. 4 million homes were foreclosed. Roughly $11 trillion in household wealth was destroyed. The banks recovered. Most of them set new profit records by 2013. Maybe I'm seeing patterns where none exist. But what I keep returning to is the symmetry of the losses and the gains. Every dollar of household wealth that was destroyed in 2008 and 2009 had previously been extracted as profit, in origination fees, in securitization fees, in credit default swap premiums, in management fees on 401k accounts invested in mortgage-backed securities. The money didn't disappear. It moved. It moved from household balance sheets into institutional accounts. And then, when the instruments that had facilitated that movement collapsed, the cost of the collapse was borne by households through unemployment, foreclosure, and the government debt taken on to stabilize the financial system, debt that would be serviced, through future taxes, by those same households. That's not volatility. That's a mechanism. Speaking of mechanisms, there's one more thread I want to follow. Student loan debt. In 1970, total outstanding student loan debt in the United States was approximately $1 billion, negligible. By 1993, it had grown to $100 billion. By 2010, to $1 trillion. Today it exceeds $1.7 trillion, making it the second largest category of consumer debt after mortgages. The growth of student loan debt is directly correlated with the defunding of public higher education, a defunding that occurred systematically at the state level beginning in the late 1970s, as the tax revolt politics pioneered by California's Proposition 13 in 1978 spread across the country. As public subsidies fell, tuition rose. As tuition rose, students borrowed. As students borrowed, the federal government, which had converted its student loan program from direct lending to a bank guarantee model in 1965, then back to direct lending in 2010 under the Student Aid and Fiscal Responsibility Act, became the largest single holder of consumer debt in the United States. The taxpayer, in other words, now holds the debt of the students who cannot pay. And the institutions that charge the tuition have already been paid. There's a file at the Department of Education's National Student Loan Data System that contains repayment data for every federal student loan originated since the program's expansion in the 1990s. Some of this data is publicly accessible in aggregate form. Loan-level data, the kind that would allow researchers to track repayment trajectories by institution, program, and cohort, is not routinely released. A 2019 Government Accountability Office report noted that the department lacked reliable program-level cost estimates for the student loan portfolio and that its models for projecting default rates had significant methodological limitations. The report was published in March 2019. It sits, as far as I can determine, largely unread. Here is where the pattern coheres. From 1980 to 2008, 20 years, the mechanisms of American wealth accumulation were systematically transformed. Long-term institutional savings vehicles, pensions, savings accounts, regulated mortgages, public university subsidies, were replaced with short-term, market-exposed, fee-generating instruments, 401k, home equity lines, subprime mortgages, student loans. Each transformation was framed as expanding individual freedom and market efficiency. Each transformation transferred risk from institutions to individuals. And each transformation generated substantial, sustained fee income for the financial sector, income that was extracted whether the underlying asset performed or not. By 2008, the average American household carried more debt than at any point in the country's history, owned fewer liquid assets than at any point since the 1940s, had a retirement account exposed entirely to market risk, and was likely a single job loss away from a default cascade. This was not an accident of culture or individual behavior. It was the predictable output of a policy architecture constructed over 3 decades. The part that stays with me, the thing I can't quite resolve, is that most of the documents are accessible. They're not hidden. The Federal Reserve publishes its historical data. The Congressional Budget Office publishes its projections. The Financial Crisis Inquiry Commission published its final report in January 2011. The GAO publishes its audits. The architecture of what happened is visible, in pieces, scattered across 100 different federal repositories and academic data sets. What's missing is synthesis. What's missing is the single document that says, here is the plan, here are the stages, here is the outcome we intended. That document, if it exists, is not in any public archive I've found. Maybe it doesn't exist. Maybe the outcome was emergent, the product of thousands of individual decisions made by thousands of actors, each rational in isolation, each contributing to a system none of them fully saw. That is, in some ways, the more disturbing possibility. A conspiracy can be exposed. A system just runs. Somewhere in the basement of the Federal Reserve Bank of New York, there are records of every emergency lending decision made between September 2008 and June 2009. Some of those records were released following the 2011 GAO audit and subsequent Freedom of Information Act litigation. Others remain restricted under the Fed's interpretation of its statutory exemptions. The loans they document, the mechanisms by which the financial system was stabilized, were made, ultimately, against the collateral of the American public's obligation to repay. They were made in our name, to institutions that had, by any reasonable accounting, created the crisis, at interest rates that those institutions could not have obtained in any private market. And then the institutions lent money back to us, for cars, for college, for houses, at rates that bore no resemblance to what they had paid. I don't have answers. I have the documents, and I have the numbers, and I have the pattern they describe when you lay them end to end. The savings rate that dropped to zero. The pensions that became 401ks. The Glass-Steagall repeal. The subprime originations. The GAO audit that no one in 2011 seemed to believe meant anything. The student loan portfolio sitting on the federal balance sheet like a slow-motion default. Each of these things, in isolation, has an explanation. Each explanation is technically accurate and deeply incomplete. What I know is this: the America that emerged from the financial crisis was structurally different from the one that entered it. Homeownership rates fell and have not fully recovered. The share of income going to wages versus capital has continued to compress. The financial sector's share of corporate profits, which stood at roughly 10% in 1950, now consistently exceeds 25%. And household debt, after a brief contraction following 2009, resumed its long climb. The mechanism is still running. Somewhere there is a 22-year-old holding $80,000 in student loan debt for a degree whose wage premium has already been competed away. Somewhere there is a 61-year-old watching the 401k that replaced his pension move with the market. Somewhere there is a family whose home is worth less than their mortgage, not because they made bad decisions, but because they were positioned, by a system built over 28 years, to absorb a loss that someone else had already captured as a gain. The archive is still there. The data is still there. The pattern is still there. I don't have answers. Only patterns. And once you see it, you cannot unsee it.